With the latest catch-up in silver and other precious metals, the question arises, will the gap gold has left during its latest bull run be closed by other metals following suit? Unlike gold, where central banks are the largest buyers, silver is not held in any significant quantity by monetary authorities. Russia has announced intentions to build silver reserves, but little detail has emerged so far. In practice, silver is primarily an industrial metal, with the bulk of demand coming from manufacturing. There are plenty of bullish factors going on currently for silver, including its consistent deficit, its industrial demand, and how undervalued it is compared to gold. Some even go on to say it has prospects to become far more worth than gold due to its view as a strategic metal. The case for it being considered as a strategic metal makes sense due to its necessity in many everyday appliances, from computers to electronics, as well as the technologies mentioned above. Gold and silver are instruments similar in many ways, with a strong correlation through history. Silver is, of course, the more volatile of the two precious metals, but nevertheless it often trades in relative tandem with gold. We all know why gold led the decoupling in the last bull run, but why would silver outperform in the following year? There are higher time frame trends like higher industrial demand from emerging sectors due to factors like the transition to renewable energy and the emergence of AI technology, which will be highly supportive for the metal over the next few years. Solar panels are an especially exciting sector as manufacturers have found increasing the silver content increases energy efficiency. But we are more interested in the now. The highest price for silver was just under $50 in the 1970s, and it came close to that level again in 2011. The commodities price uptick came on the back of very strong silver investment demand. While it has yet to reach these levels again, the silver price has increased significantly in recent years. Silver used to trade at 15 to 1 to the price of gold. At today's price of gold, that would be over $200. The primary reason that silver is sold at a significant discount to gold is supply and demand, with more silver being mined annually. While silver does have both investment and industrial demand, the global focus on gold as an investment vehicle, including countries stockpiling gold, can overshadow silver. There is an abundance of silver, according to the U.S. Geological Survey. To date, 1,740,000 metric tons of silver have been discovered, while only 240,000 metric tons of gold have been found, a ratio of about 1 ounce of gold to 7.1 ounces of silver. In terms of output, 25,000 metric tons of silver were mined in 2024, compared to 3,300 metric tons for gold. There are merits for both metals, especially as part of a well-balanced portfolio. As many analysts point out, silver has been known to outperform its sister metal gold during times of economic prosperity and expansion, which, contrary to doomsday beliefs, is the current state of the economy. The lower time frame factors pushing the price are the robust industrial demand, a second consecutive year of substantial supply deficits, rapidly declining inventories, and renewed safe haven buying amid inflation concerns and geopolitical tensions. Russia's recent announcement to expand its precious metals holdings with silver is another notable example. The country plans to acquire $535 million worth of silver over the next 3 years, marking the first time any central bank has explicitly included silver in its purchasing plans during the current bull market for precious metals. Now let's get into some supply and demand numbers. The silver market faces significant supply challenges heading into 2025. Total silver supply has actually declined over the past decade, dropping from 1.07 billion ounces in 2010 to an estimated 1.03 billion ounces in 2024. Meanwhile, demand continues to outpace production. The market has experienced consistent supply deficits since 2021, with 2023 recording a substantial shortfall of 184.3 million ounces. This trend is expected to continue as 2024 consumption is projected to reach 1.21 billion ounces. With supply at only 1.03 billion ounces, this creates a significant deficit of 182 million ounces, a situation that could drive prices higher. A very important thing to know about silver and how its price can be affected by other metals like zinc and nickel is that 75% of mined silver is a byproduct of mining for other metals. Due to this fact, that silver mostly depends on the mining of other metals, it is very important to follow how other metals are being mined. Everything that would constrain the production of other metals would affect silver prices as well. This might be the case currently. With the tariff announcements, all of the related metals have been given a boost in prices. Lead, zinc, copper, gold, and nickel are all metals whose production yields silver as a byproduct. Apart from this, growth in capital expenditure has been decelerating this year. Capital expenditure in mines tends to have a lagged relationship with the price of industrial metals. So, although industrial metal prices are up strongly this year, we expect the capital expenditure in mines to continue to decelerate given that prices in industrial metals were falling 18 months ago. In September, Russian President Vladimir Putin said he was considering limiting exports of various metals, including nickel. Should he follow through with this threat and production of these metals decline in parallel, less silver as a byproduct may be available in global markets. These are all factors which make us believe silver, amongst other precious metals like palladium and platinum, will continue to close the gap in the near term.